This is OwlUp, where learning happens in minutes, not hours. For a deeper journey, explore all our courses at owlup.co. Now, let's dive in. Chapter 1 of Read a Balance Sheet, Financial Literacy for Non-Finance People. Introduction to Financial Literacy. In this chapter, you'll learn: define financial literacy and its importance for non-financial professionals. Let's dive in. Last year, the average retirement account in the U.S. lost almost a quarter of its value. Now, pause on that. In 1 year, a safe future shrank dramatically. In this episode, we'll follow the money trail and uncover how basic financial literacy turns shocks into strategy. A 23% drop in a retirement account feels personal, but the mechanism behind it is almost boringly mechanical. Numbers moving on 3 core reports every public company must publish. In this episode, we zoom in on one of them, the balance sheet, and connect it directly to your real-world choices, from picking an employer to judging a stock to assessing your own net worth. We'll look at why assets equals liabilities plus equity is more than an exam formula. It's the backbone of how businesses survive shocks like 2022, and why some don't. You'll see how tech giants fund big bets like Amazon's recommendation engine without running out of cash, and how the same logic applies when you decide between taking on debt or building a savings buffer. By the end, you won't just recognize a balance sheet, you'll start using its logic in your own financial decisions. If the balance sheet is your snapshot, this episode focuses on what that snapshot lets you do. We'll move from reading the numbers to reading the story behind them, how a fast-growing tech company might carry heavy debt on purpose, why a cash-rich business can still be fragile, and how expansion into AI or cloud services quietly reshapes what shows up on the page. We'll also connect this to you, using the same lens to compare employers, spot red flags in headlines, and see where risk is actually hiding versus where it only feels scary. Think about what the balance sheet doesn't show at first glance, and that's where it gets interesting. Start with time. The balance sheet freezes one date, but your decisions play out over months and years. When you see a tech firm with big borrowing, the next question isn't, is debt bad? But what time horizon are they playing on? Short-term debt funding long-term projects is like bridging a canyon with a ladder. It might work, but the mismatch is risky. Matching long-term bets, like a multi-year product build, with long-term funding, equity or long-dated loans, is one of the quiet skills of financially literate managers. Next, zoom in on composition, not just totals. 2 companies can both show $1 billion in assets and yet live in different universes. One might hold mostly cash and short-term investments. The other, patents, software code, and data centers. The first can pivot fast. The second is committed. When you scan a tech company's long-term assets, you're really asking, how locked in is this strategy? Now layer in quality of what's owed and owned. On the liabilities side, look at who gets paid first. Trade payables to suppliers, deferred revenue from customers, bank loans, bonds. Each has different urgency and consequences if things go wrong. A company leaning heavily on customer prepayments, for example, has already been front-funded by the market. That can be powerful if the product is sticky, dangerous if refunds spike. On the equity side, ask how much loss-absorbing cushion exists. Thin equity and towering obligations mean even a small downturn can wipe out owners, and sometimes jobs. That matters when you're choosing where to work or where to park your 401k. For tech especially, watch recurring patterns. Growing deferred revenue often signals strong subscription models. Swelling goodwill after acquisitions hints at an appetite for buying growth rather than building it. And here's where the 3 financial statements quietly intersect. The income statement tells you if the current playbook is profitable. The cash flow statement reveals whether cash is actually arriving, but the balance sheet records the cumulative bets and obligations that restrict or expand your next move. Learning to read that interplay is what turns numbers into strategy. Watch what happens when a fast-growing software company shifts from selling one-time licenses to subscriptions. On day one of the switch, revenue growth might look slower on the income statement, but the balance sheet quietly starts stacking promises. More customers paying monthly, more predictable inflows later. That growing line of customer prepayments isn't just accounting trivia. It's a clue that the business is trading quick wins for long-term stability. Now, contrast that with a chip manufacturer ramping up a new product. You'll see heavier investment in equipment and inventory long before headlines talk about next-gen processors. Those numbers hint at how confident management is about future demand. If spending jumps but related sales don't follow over a few reporting periods, you've spotted tension between the story in earnings calls and the story in the filings. Your personal finances leave similar traces. A surge in high-interest debt without a matching rise in durable assets is like upgrading the facade of a house while neglecting the foundation. Eye-catching today, fragile when conditions turn. That same skill you're building with corporate filings can quietly reshape your own choices. As more of life moves on to subscriptions, in-app purchases, and buy now, pay later, your personal money trail starts to look like a mini enterprise. Each new app or auto-renew is a small contract on your future time and income. Over years, those micro-commitments can crowd out bigger goals, like learning a foreign language one word at a time while never practicing full sentences. Your challenge this week: pull one annual report from a company you use daily, streaming, shopping, or social, and flip straight to the balance sheet. Circle 3 items you don't recognize and look them up. Treat it like exploring a new city by side streets, not landmarks. The odd labels often reveal where the real risks and opportunities hide. This was OwlUp, your daily step forward. To keep learning with structured courses and more insights, go to owlup.co. Until tomorrow!